You think this is just geopolitical noise? It is not. The market is now being forced to price a real energy shock. Overnight, major fuel and storage sites tied to Tehran were hit, and the broader conflict has already disrupted oil and gas flows across parts of the Middle East. That does not mean the entire global energy system is broken, but it does mean the market can no longer assume cheap, stable supply. Crude has already surged into the low $90 range, and if this conflict expands further, traders will start asking whether $100 oil is no longer a tail risk, but a real scenario. And once oil spikes, the impact does not stop at the gas pump. Higher energy prices flow straight into freight, manufacturing, shipping, chemicals, and power. That is where this story becomes a margin story. If companies have to pay more to move goods, run factories, and power digital infrastructure, profits get squeezed. Not all at once, but steadily, quietly, relentlessly. That is especially important for big technology companies. Investors love to talk about AI like it exists in a weightless digital world. It does not. AI runs on data centers, and data centers run on electricity, cooling, construction, and grid capacity. Microsoft, Amazon, Google, and other hyperscalers have recently committed to pay for major new power delivery upgrades tied to their data center expansion. That may protect households from higher bills, but it also means the economics of AI growth are becoming more exposed to real-world energy and infrastructure costs. So the question is not whether AI demand is strong. The question is whether margins can stay strong if energy stays expensive. At the macro level, this shock is also making the Federal Reserve's job harder. Higher oil and gas prices can keep inflation sticky. That is one reason markets have already started pushing back expectations for rate cuts. Treasury yields have stayed elevated, the dollar has remained firm, and investors are being reminded that an energy shock can delay the path to easier financial conditions. That does not mean rate cuts are gone forever, but it does mean the market may have been too optimistic about how quickly relief would arrive. So what should you watch next? Watch Crude. Watch the 10-year yield. Watch the tone from transport, industrial, consumer, and cloud infrastructure names. If energy pulls back, this may fade into another temporary geopolitical scare. But if oil stays high, this becomes a cost story. And when it becomes a cost story, it becomes a margin story. That is where the real repricing begins. This is not financial advice. Keep your eyes on the margins. I'm Wilson. See you tomorrow.